Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Hello, everybody. My name is Thane Stenner. I'm the host of the BNN Bloomberg SmartWealth podcast, where I get to interview some of the leading minds in different industries and sectors. And I'm with a very special guest here today, David Rosenberg. David, first of all, thank you for taking the time out of your always very busy schedule to be with us today.
Pleasure to be here.
Excellent. And there's going to be lots for us to talk about. For those of you who've been listening to the podcast, David and I had an interview podcast last year around the same time in August. And as is usual, David is very forthright with his comments, forecasts, and whatnot. And I think if you haven't listened to him before, you're going to really be in for a treat here today. So with that in mind, I'll start off by providing a little bit of David's bio to begin with, and then give a little bit of background as well around him. So David is the founder and president of Rosenberg Research, an economic and financial market consulting firm, which he established back in January of 2023. So first of all, David, the last 3.5 years, does it feel like since you set up shop, independent shop, does it feel like 3.5 years ago, or has time flown for you?
Oh, it's as if nothing happened.
Yeah, just a little bit of COVID, and a recession and whatnot. Exactly. Well, prior to creating his own company, David was also the chief economist and strategist with Gluskin Sheff and Associates from 2009 to 2019, so roughly 10, 11 years. And prior to that, from 2000 to 2009, he was at Merrill Lynch, where for the first 2 years, he was the chief Canadian economist and strategist based out of Toronto. And for the last 7 years, he was the chief North American economist at Merrill Lynch in New York, where he was consistently ranked in the top 3 of all Wall Street economists polled by the annual Institutional Investors. And actually, this is where David and I think first met, was roughly over 20 years ago when I was also at Merrill Lynch earlier on in my career. David is also a frequent contributor to most major financial newspapers and publications in North America and makes regular TV appearances in the financial media. He received both his BA and MA in economics from the University of Toronto. So he's a fellow Canadian based in Toronto these days, but very much with a global footprint on how he thinks. So for full disclosure, David, his research of his team, we're also a subscriber as an investment group, Stenner Wealth Partners here, part of CG Wealth Management. And I have to tell you that their research that they publish on a very consistent basis is some of the very best that we get access to on a global basis. So keep up the great work, David and team. But there's a piece that I'll refer to as we go through some of the questions. It's called Breakfast with Dave. And I think, Dave, you've had that piece named that for, I think it literally goes right back 20 plus years, doesn't it?
Well, it changed monikers along the way. I started that when I was working at the Bank of Montreal back in 1997.
Yes.
And it was called something a little, shall we say, less sexy or a little more boring. It was called it was called Morning Market Memo because I love alliterations.
Gotcha.
But the folks at Gluskin Sheff, they like to jazz things up. So why not introduce some food into the vortex? So Breakfast with Dave. So actually, I would say Breakfast with Dave. That title's been here since 2009.
Oh, fantastic.
And I kept the trademark when I started my business.
I figured you did. Very smart move on your part. You're a good businessman as well. Well, actually, one of the things I missed saying in your bio is you, Rosenberg Research right now, as an independent research group, you've got something like 2,600 clients, both retail and institutional, globally now.
Well, it's glad to say it's up to 2,800.
Wow.
When I left Gluskin Chef in January of 2020, and this was one of the benefits of having a business within a business, because I had 1,600 of my own clients. They were not Gluskin Chef clients. These are people that did not want money management. They did that on their own. They wanted to have advice given to them. So I started the business. I had 1,600 clients. We're up to 2,800 in just over 3 years.
Wow.
And half our clients are institutions, half are private investors.
Yep.
And we're in 40 countries. So we truly are a multinational organization.
Wow,
Not that big, but we're still multinational.
Absolutely. How many people on the research team these days?
Well, in total, I have 16 or 17 people. I always wonder, should I include myself or not? We have probably, I think, 8 on the research side, and the other, call it 8 or 9 people. You know, we have technology, and we have marketing, we have sales, admin, obviously. My son Jacob is the de facto COO. He doesn't like the word chief in his name, so he's head of operations, but I still call him COO because I'm old school, and I suppose I have a little bit of Larry David in me. So in any event, yeah. So it's about, I'd say, about 8 people doing both strategy and economics, and of course, always marrying the two and doing our best to come up with advice and recommendations on how to navigate through these crazy markets, which are always crazy. It's always just a matter of degree.
I absolutely agree. And both you and I have been in the business long enough to know that to kind of expect craziness at different times. So with that in mind, you know, you and I chatted about a year ago, almost to the day, and you were very open with your perspectives back then. So first question for you is, what would you say you, from a forecasting perspective, that you felt like you got right over the course of the last year, from, you know, August 2022 to these days? What are the things that you'd say, yeah, we kind of nailed those things?
Well, I guess there's a couple. There's stuff that I nailed, stuff that I missed, but I think that's always the case with you know, prognosticators, because you know, as
probabilities.
Yogi Berra famously said, it's tough making predictions, especially about the future. So I'd say that you know, having been part of that transitory camp on inflation, and then getting pasted as we went from 0 to 9% in pretty short order. It was practically unprecedented to have 4 years of price increases just lumped into 1 year. It's never happened before. And so I'd say that the one call that I got right is, you know, I kept on saying that this 9% inflation rate, which was the peak back in June of 2022, that was not sustainable. It was not going to lead to a relentless wage price spiral. This is not going to be a new era of inflation. And of course, the debate back then, and there's new debates today, was whether or not we were entering into the 1970s. You know, to which I said, you know, in the 1970s, we had 9% plus inflation 2/3 of the time. That's secular inflation. We had inflation of 9% for 1 month, and look what's happened. It's down to 3%. The only other times historically where in a span of call it just over a year, that we've had inflation go down this much, it's only happened in the mid 70s, the early 80s, and in 2008, 2009. All were recessionary periods. We haven't even really had the technical recession yet. And look how far inflation has come down. And a lot of that has to do with the fact that global supply chains, notwithstanding the ongoing war in the Ukraine, that the global supply chains, those cost pressures have abated. So I think that the one call I got right was that inflation was going to come crashing down. I guess we could debate as to whether or not it's come down enough. The central bankers are tied to this holy grail of 2%. So, you go from 9% to 3%, and it's not good enough for today's central bankers because their badge of honor is 2. And as Tiff Macklem said, the head of the Bank of Canada, that, going down to 3 is one thing, that last leg down to 2 is going to be a lot tougher. And he's probably not wrong on that. So I would say that is one call that we got right. The other call is that, and I have to say that, no, I have not been bullish at all on the U.S. stock market. So I missed out on that. But we were pounding our fist this time last year on Japan. And we saw Japan as a bona fide turnaround story with much better valuation metrics, but also the legacy of Abenomics. There's an equity culture going on in Japan right now that looks a lot like the United States back in 1982. You're not seeing corporate Japan hoard cash anymore. There's activism taking place. There's regulatory measures being taken place that's compelling these very stodgy, cautious, conservative Japanese companies to start returning cash to shareholders. That's really the overall story. It's not really about the economy. It's not really about the weak yen, although that's certainly a boon to exporters. But there is a re-rating going on in the Japanese stock market. And the first people that have caught on to it are global investors. They're the ones that have been buying. The locals in Japan have not caught on yet. So wait till that happens. So I think that those two calls, I think the disinflation call, and of course, bond yields have backed up in the past couple of weeks for a variety of reasons. But, there was people a year ago saying we're going to 5, 6, 7% on the 10-year note. And I pushed back hard against that view, and I still do. But I'd say that the disinflation momentum and the bullish call in Japan really played out very well for us over the past 12 months.
Yeah, excellent. And I think there was also some thoughts around 12 to 18 months, kind of the 10-year U.S. bond yield getting down to maybe 2.25. But having said that, sometimes, being early, eventually you're right. And from what I've seen in your research work in the past, it kind of reminds me reminiscent of the 2007 to 2009 period. So
right.
Are you still in the camp that we're going to have a recession, number one, and also how bad might it be at this point from what you're looking at in the data?
Well, look, it's a great question. At this point last year, when you and I were talking, the Fed was barely halfway into its tightening cycle. The yield curve had only inverted the month before. And it was only in November that the New York Fed's 3 yield curve recession probability model moved above 70%. So I hear people all the time saying, where's this recession already? Where's the recession? And all the people that were calling for a recession were dead wrong. They weren't dead wrong. Were they early? Well, I don't remember anybody putting an exact timestamp on it. When you and I were having this conversation a year ago, all I said was, there's never been a Fed easing cycle that failed to promote an economic recovery. Nobody ever debates that. And not every single Fed tightening cycle necessarily leads to a recession. But we have had 14 Fed rate hiking cycles since 1950. And these tightening cycles created the conditions for a recession 11 of those 14 times. So what I was saying back then, and I'll continue to say today, is, in this game of trying to help investors out, and now we're in the probability bands and trying to minimize making an error and always focusing on what the risks are, is that in a Fed tightening cycle, you stand an 80% chance of having a recession sometime thereafter. And we know the lags are long and variable, and other things are happening at the same time. You've got this wonderful U.S. Industrial policy, the CHIPS Act. You had the final leg of the excess savings from all the crazy stimulus checks that were given to the proletariat back in 2021. And all that, of course, helped thwart the impact of the Fed so far. But it's still early. And the lags between the onset of the Fed tightening cycle, which remember was March of last year, and the recession is usually about 2 years. Now, it could be 1 year, it could be 3 years. We're just talking about the law of averages, but typically it's about 24 months. So the recession is still out there. We haven't seen the full impact of what the Fed has done. A lot of the impact was blunted this year by fiscal stimulus that is not going to be repeated in 2024. So I think the jury is still out. I'm just amazed at the number of people that have thrown in the towel, the people that had my view that throw in the towel. I think that they will regret it. It's one thing to say, well, it's taking longer this time. I mean, you talked about, back in 06, 07. Remember, the Fed started tightening in June of 04. The recession started in December of 07. Everybody was saying the same thing back then. In 06, that's all I lived at Merrill Lynch. Where's this recession? Where's this recession? Well, back then, it wasn't about fiscal policy that, created the lag to be so long. It was those other acronyms. Today's acronym is FOMO for the stock market. But back then, regarding the housing market, it was MEW, it was MU, it was mortgage equity withdrawal and cash out refinancing. So we still had that last leg, that last year. Back in 06 and 07, before the recession, people were still, breathing the fumes from the previous housing bubble. And so we've had the fiscal situation this year that's provided a bit longer of a lifeline for the expansion. But I'll just tell you, Thane, that I have some hardcore beliefs. I believe that interest rates do matter. They matter for the economy. They matter for financial assets. How else do you value anything with a stream of cash flows if you don't have an idea of where interest rates are? So it's one thing when interest rates are zero and the Fed has destroyed the equity risk premium entirely, and you're going to have a Jack and the Beanstalk market rally, even in the context of the height of the COVID back in 2020. Think of the craziness in the economy and in our lives back in March of 2020, and the stock market goes vertical north. Well, of course, shows you the power of interest rates. It's funny thing that when the Fed's cutting rates, everybody says, don't fight the Fed, don't fight the Fed, don't fight the Fed. But in our business, which is built on optimism at all times, when the Fed's raising rates, nobody says, don't fight the Fed. It's always like, let's look somewhere else. But interest rates matter. Interest rates matter a lot. And the economy resets to those interest rates with lags that can be 12, 24, 36 months. Okay. So I think the recession has been delayed, but not derailed, just like it was. It was delayed in 06. It started towards the tail end of 07. So I believe interest rates matter. And I don't believe that the business cycle has been repealed. So I say that 100% true. The people that were calling for recession are on their back heels. You could suggest that I'm one of those people, but I haven't backed away from the view just because it hasn't happened yet. Remember I said that the New York Fed, it's funny, John Williams is not an interest rate hike he didn't vote for, or he voted for every one of them. But this recession model goes back 50 years. And when you cross over 70%, there's no turning back. You've always had a recession. It's usually, call it roughly a year after you cross a 70% mark. Well, we only crossed a 70% mark in this indicator last November. So I'd say, we know that the first quarter, 2.4% real GDP. We know that the Atlanta Fed, I think they're at 5.8 right now. It's funny, the St. Louis Fed is at 0.6. I think they're at 0.8. The other one's 5.8. Somebody's got a decimal place in the wrong spot in those two forecasts. But I'd say the fourth quarter, if you're going to ask me, I think the fourth quarter, I sense we will be staring the recession in the face at that point.
And the reality is the data is lagging too at that point too, right? So it's only confirmed subsequent and over time as to whether or not, so that's one of the things that I think people have to kind of wrap their minds around. Okay, we're going to take a quick break. We're with David Rosenberg, so stay with us. We'll be right back. Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Welcome back, everybody. I'm with David Rosenberg as my special guest, and we're going to get right back into it. You penned a column in the Financial Post recently. I think it was the Financial Post, where I think you mentioned something along the lines of reminding yourself back in the '07 period, where I think you were called the skunk at the picnic, so to speak. And I'm saying this with a lot of respect because you wrote it. But are you feeling like, maybe just describe why you penned that column recently, kind of what was behind it, and maybe share a little bit as to the historical relevance of that column?
Well, look, it's a matter of social media has its I guess you could say its pluses and its minuses. So when you're out there and you're a personality and you have and you're opinionated, you're going to get sometimes great comments that support your view, but at points when you're viewed as completely wrong and in the wilderness, it's open season on the Bears. And so the hate mail, for example, the hate mail has been incredible. I think that I think it was Jacob that said to me, "Dad, you don't want to check your Twitter account for the last couple of days because
It's gotten hostile.
I mean, like I said to him, you're not embarrassed that I'm your father, are you?" So, but it was that because the same thing happened at Merrill. It wasn't the first time. The first time at Merrill was in 2000 when people called me a Luddite because I didn't understand the power of the internet. Like today, I don't understand the power of AI. I don't understand the power of the Biden Chips Act. I don't understand any of this. But I know that there are things that have long-term productivity impacts, and then there are things that also in the here and now create the conditions for a financial asset bubble. So in any event, it just everything I'm seeing right now, especially everybody throwing in the towel. Everybody in '07 threw in the towel.
The cautionary towel is what you're saying.
The recession towel. I think the only two people left standing were me and Dick Berner, who was chief economist of Morgan Stanley. They were still. I mean, their consensus did not start to call for the recession until Fannie and Freddie went down for the count in conservatorship, and that was in July of '08. Even after Bear Stearns went down, soft landing, the consensus was soft landing the whole way through. And the recession started in December of '07. Nobody knew about it. And that's what I mean. Recessions are they're like an odorless gas, they catch up on you. And you're right. You get the revised data. People haven't talked about the fact that non-farm payrolls, the holy grail of all the economic data, they have been revised down every month this year. The back data have been revised down every month this year by a total of 270,000. So I say to people, do you understand you are trading off a number on 8:30 in the morning on Friday that is fictitious. And it's and the same thing with GDP. All these things get revised. We've actually been in a recession on GDI, gross domestic income, the actual money that we make, because we've been in a profits recession for the better part of the past year. We've been in an earnings, we've been in an income recession, but GDP is all about spending. And so with the help of the lagged impact of the fiscal stimulus checks and the binge we've been seeing in terms of credit card usage, that's created the allure of prosperity because we look at GDP and we always measure the economy based on spending. But if you looked at real income in aggregate, we've actually been in recession, and it's very unusual, by the way, to have what's called GDP and GDI diverge by as much as it has. So these will ultimately get reconciled in the national accounts.
Gotcha.
So let's just say that I'm feeling the heat, but I'm to quote Tom Petty, I'm not going to back down. And I'm going to maintain my resolve, because I did that in 2000 when I was called a Luddite. And I was proven right, because the recession came in 2001 when nobody saw it coming, including Alan Greenspan, no matter how smart he is. And then in 07, I was called the skunk at the picnic. And look, that's Thane, that's just what they said to my face.
Yes.
And so I sort of thought, you know what? Okay, time to start dusting off the books and just saying to everybody, I have been here before. I have a good handle on what's happening. I understand this recession in a classical sense has not started yet. I'm also keeping an eye on the leading indicators. As you mentioned, everybody's focused on coincident and lagging indicators. By the way, so is the Fed, so is the Bank of Canada. They've been so shamed by missing the inflation that they are not going to risk anything. That inflation gene, that inflation, that genie's going back in the bottle for good, and they're going to over tighten. And they probably already have.
Which actually leads me to my next point. You think there will be an overshoot of this tightening cycle? I guess
it's happened. It's happened. When you tighten policy this much into an inverted yield curve, it's a fait accompli. As I say on the Quebec side of the border, les jeux sont faits. The gig is up. It's just a matter of lags. The reason, when I said before that you've had 14 Fed rate hiking cycles, but 11 recessions, I didn't say 14 recessions. We had 3 real soft landings. We had 3 periods where the recession was averted for years, and that was in the mid-60s, the mid-80s, and the mid-90s. The mid-90s, of course, was that period where Alan Greenspan developed the moniker of the maestro. But you see, what made those 3 periods special was that the Fed and the Bank of Canada stopped hiking rates before the yield curve inverted. These central banks, because they are so consumed with inflation, have continued to raise rates well past the point of inversion of the yield curve. And there's nothing magical about the yield curve, except it's a price signal from the bond market that tells a central bank you've gone too far. I don't think people understand how abnormal it is to have a situation where short-term interest rates are above long-term interest rates. Anybody who studied the time value of money knows that that is unnatural. And it has only happened 15% of the time in the past. And it only happens when the Fed or the Bank of Canada raises rates so aggressively that they take short-term rates above long-term rates. Only happens 15% of the time, but it's the bond market's way of saying uncle to the central bank. So in answer to your question, I know it's not evident to the naked eye today. You look at this number, look at that number, they're all contemporaneous indicators. They're not suggesting anything nefarious. I spend most of my time trying to forecast what the headlines are going to read 3, 6, and 12 months from now. I'm not trying to forecast what the headlines read today. We already know that. We already know what's happening today. How is the outlook being shaped? That's really what's important, and that's what I'm focusing my attention on.
So let's drill down a little bit deeper on that. 3, 6, 9, 12 months. Let's just go with 12 months. 12 months from now, what would be some of the headlines that would not surprise you, or that you think we'll be reading?
I think we'll be reading about that the recession is here. I think that if you give me a 12-month window, and that's being charitable, but economists like big windows.
I know. I did
big
that
windows for us to fall out of. But I think that, if the recession doesn't come in a 12-month span, I will write a report saying it is a new era. Interest rates don't matter, and the business cycle has been repealed. And I will be eating a lot of crow and wiping a lot of egg off my face. I think it's a little early to make that assertion, but I think in the next year we'll be writing about rising unemployment. We'll be writing about deflation, not inflation, deflation. And that's why I've not abandoned my call for where the 10-year note's going to go down to 2.5%. Of course, it hasn't happened, yet. I heard that all throughout 06 and 07. I heard that all throughout 1999 and 2000. You have to sometimes just be patient and maintain some resolve. I just find that so many of people in the marketplace today, that's why I love there's the Robin Hood accounts. It was a great sociological development. That the degree of narcissism and the short-term nature of investing today or forecasting. We're talking about where the next big move in interest rates is going to be down, not up. And that's true across the curve.
Mm-hmm.
So I think we'll be talking about lower interest rates. I think this notion of the central banks, central banks are telling us higher for longer, higher for longer. That's what they want us to hear right now.
Yes.
They were also telling us in 2021 that interest rates were going to stay at zero to perpetuity. In fact, when they first unveiled the dot plot, the Fed unveiled the dot plot in 2021. For the end of this year, it was 0.625%.
Whoa, that's
And
right too.
and we're now what, 5.25, 5.5. Oops.
They missed the decimal place.
Let's just I shouldn't really sit here in a glass house and throw stones, but let's just say that I know the Fed they want us to believe rates are going to stay at zero, and then that didn't happen. Then they want us to believe that rates are going to stay elevated for a prolonged period of time. I don't think that's going to happen, because interest rates at their root are cyclical. Yeah. And I think we are past peak inflation. I think we are past peak of economic growth. I think we are certainly past peak of the credit cycle. I think you're going to be hearing a lot about the tightness in financial conditions. We just talked about the Fed and the cost of credit, but every survey is telling you something about the availability of credit. And I find look what's happening right now with Fitch. Now, Fitch didn't stop what the U.S. government did it. Now it's going after the banks. Yep. Well, this is what we're going to go back. It's like, we went back and thought, oh boy, 2007, January of 2007, what happened? That was like a canary in the coal mine. What was that? It was when New Century Financial closed its doors. January of 2007, the recession started. About a year later, the stock market didn't peak till October of 2007. And so that to me was always a flashpoint. New Century Financial, like, who are those guys? Well, Countrywide ended up following them. They were a significant subprime lender, not the biggest in the business, but that was a flashpoint. So you're going to tell me, and I'm just saying this, I'm pausing this, talking in the third person. You're going to tell me that we had some pretty significant regional banks close their doors and shutter, back in March. And we're going to look back and we're going to say, oh yeah, why didn't I pay attention to that? And so we are seeing that when you're taking a look at bank wide, and of course we got Jamie Dimon and Brian Moynihan going on CNBC with their smiling faces. They know what's going on. You see these banks, they're raising their loan loss provisioning like it's nobody's business. They know a credit default cycle is coming down the pike. Look what they're doing with their loan loss reserves.
Yes.
And they will continue to do that. We're already starting to see auto loan default rates and credit card default rates already go back to their early pandemic highs. And so we are seeing the onset of a credit contraction. And I know it's not showing up right now in the data, but there are lags involved. We have the cost of credit, rates up 500 basis points, and we have the availability of credit. If you're taking a look at bank assets and bank liabilities in the United States, they're running negative year on year. The banks are shrinking their balance sheets, and nobody's talking about it. So we're going into what will they be writing about? A negative credit cycle, default rates going up, recession, rising unemployment, deflation, and the central banks will be cutting rates. Nobody ever thought that they'd be cutting rates in 2007. Well, they did. Nobody ever thought they'd be cutting rates in 2001. Well, they did. Nobody ever thought they'd be cutting rates in 1990. Well, they did, because interest rates are cyclical. So that's what we'll be talking about. And then we don't know what the geopolitics are going to look like. The war, the Russia-Ukraine war is not going away. What are the next chapters in that war? What's Putin going to do as he gets painted into a corner? What's happening in China? How does they're heading into recession. What about China? We haven't talked about China yet, Thane. Well, how much China now is heading into its credit crunch, and they look like they're going into recession. Everybody talked about global decoupling back when I was at Merrill in 2006 and 2007. People were saying, well, don't worry, if the U.S. goes into recession, we have global decoupling. Look at China. But look what happened. There's no such thing as global decoupling. Back then, it was the world's largest economy that had the reverberating impact around the world. And this time around, it's the second biggest economy. China, what's happening in China right now is very serious. And the trade channel implications for the rest of Asia into Europe And then, of course, in the United States, the implications for commodities, which are very negative, and the implications that has for Canada, Canadian profits, the Canadian dollar. What's happening in China, that's going to be making the headlines. It already is. But that story hasn't played out yet. And
Agreed.
Beijing hasn't come up with a policy solution yet to their property mess and their debt situation, which is getting worse. And obviously, that's people were expecting. Look, the story for this year. The Bulls had the story for this year with the China reopening trade. Now, part of that's worked because you know that the casinos in Macau have been filled, but everything else. I mean, look at the retail sales numbers. Look at the manufacturing numbers, and look at the real estate. The housing market there is deflating. So China, to me, if you're asking me that, and then of course, how is this going to filter in geopolitically to Xi Jinping, and how would he get the masses? How will they get their minds off the economic problems? And then all of a sudden you throw Taiwan into the mix. And I don't want to sound like I'm stepping over my bounds as an economist. I'm more of a keen student on geopolitics.
History.
Well, yeah, these are the things, wag the dog that you have to be aware of. But I'd say in answer to your question, I think that as everybody is focused on inflation, we've gone from 9% to 3% in the United States. The numbers in Canada are higher because, of course, when mortgage interest costs are in the CPI in Canada and mortgage interest costs are up 30% because the bank's raising interest rates, the bank is actually creating its own inflation. The numbers in Canada are being inflated because of the way that the CPI is constructed. But I strongly believe, and again, I am probably crazy early on this call, understood, but I'm always more concentrated on the big calls, the big moves, and the little wiggles along the trend line. I don't care about the wiggles. Let the traders and the technical people worry about the wiggles on the trend line. I think that this decline in inflation has not been fully appreciated by the bond market, not fully appreciated by the central banks. And I think as the deflation, which is it's disinflation now, becomes deflation, and China is going to be the linchpin for that. And that's why I'm very bullish to this day on long Canadas, and I'm very bullish on long treasuries.
We're going to take a quick break right now. Please stay with us, and David Rosenberg will be right back. Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management, and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Welcome back, everybody. I'm here with David Rosenberg. Let's get right back to it. So I've got three other themes I kind of want to focus in our discussion on, near and dear to people's hearts, the real estate market, both in the U.S. and Canada, and maybe juxtapose for our audience around maybe the similarities, but also the differences as to where they're at in the U.S. versus where the Canadian real estate market might be today.
Well, the residential real estate markets in both countries up until very recently have been very strong for different reasons. In Canada, of course, it's been the massive immigration inflows. Canada has amongst the worst fertility and birth rates. We're like right there with Europe or everybody else in the industrialized world, but we've been up for it with immigration. And when you have immigrants come in, unlike, giving birth to a child, you give birth to a baby, you put the baby in the crib. The crib already has a roof over its head. But when people come in from outside the country, they create housing demand right away. And the housing demand in Canada has been phenomenal. And of course, principally in Vancouver and Toronto, because that's where people who come in from outside the country, that's where they want to live. And so we've had that aspect of it on the demand side. And because of the dearth of construction workers, we have been able to keep up on the supply side. I mean, there's other reasons too. You can argue about at the municipal level, zoning restrictions, the provincial level, land use restrictions. But the bottom line is that the supply has not kept up with the demand, and the demand has been demographic and come from immigration. And we can talk about whether that makes sense or not. But that's what has driven the housing bubble in Canada. And now you have a situation where affordability is out of control because you have higher mortgage rates and you have prices and nosebleed levels, and it's not sustainable. But for whatever reason, in the last few months, you started to see a bit of a thaw on the supply side, and it may finally be thing that the weak hands are starting to have to, list their house, because you're starting to see for the first time in Toronto and Vancouver new listings coming to the fore. Inventory starting to come back for whatever reason, and you would have thought at some point this had to happen because of the majority of Canadians that we were always so conservative taking out 5-year mortgages, but everybody took out short-term mortgages to take advantage of those ultra low rates a couple of years ago.
Yep.
And now they're going to be paying the piper. So I continue to think that, we could be in for some trouble here in Canadian residential real estate. And I'm saying in terms of housing price deflation, I mean, look, if we don't get help from interest rates by the Bank of Canada, and it doesn't look like that's going to come soon, the only way you're going to mean revert the homeowner affordability ratio in this country, barring some sort of massive income boom, which isn't going to happen now that the unemployment rate is starting to go up. Home prices in Canada have to come down roughly 30%, right? Just to equilibrate something as basic as the affordability ratio. It only has 3 variables: interest rates, home prices, and incomes. The United States, totally different. It's not an immigration story. What happened is that in Canada, as everybody flocked to variable rate mortgages, Americans back in 2020 locked in. 85% of Americans locked in. They locked in their 2 to 3% mortgage rates, and they're stuck. Now and that's why there's no inventory. Nobody, you can't list your house, because then you're going to be having to take on a new mortgage at 7.5%. And that's why, so it's created, so you got this other perverse, in both countries, for different reasons, you have extremely tight supply. In Canada, it's been the immigration story. In the US, it's been the fact that everybody refinanced and they realize, I can't move out of this home or else my mortgage rate's going to go up 5 percentage points from where I last took it on. So that's why there's no inventory. But once again, look, at some point, there's going to be a straw that breaks the camel's back, because you have the same unaffordable housing situation in the United States. It's crazy. That housing affordability in the United States is more stretched today than it was at the peak of the housing bubble back in 2006. Now, I'm just going to say, this is a mean reverting series. Everybody on the call knows I'm a Bob Farrell disciple. Rule number 1 is about mean reversion ratios, not levels, but ratios, mean revert. When people say to me, how did you end up getting the housing call right when you were at Merrill in 06 and 07? The real miracle was that I held on to my job. But all I did was I believed in fundamentals and basic premises and the laws of nature. One law of nature is the law of mean reversion. So I'm sort of wondering, like, something's got to give here. Okay, Thane, in both countries. Either we have to go through a big income boom, but those days have passed. The unemployment rate's not going down further than it already has. The income boom, that's not happening. And the central bankers seem to just basically want to continue to talk as if they're never going to cut interest rates. So what's left in the equation are home prices. And to mean revert, and that means going to the mean, by the way. When you mean revert, historically, you go through the mean in both directions. You're talking about a minimal 30% decline in home prices. And all I have is people talking to me about the AI boom here, the CHIPS Act here. Nobody's factored in where home prices, the bedrock of the household balance sheet in both countries, the bedrock, actually, of the assets in the banking system. And so there's another headline that nobody's talking about that will be making the headlines in the next 12 months
So
is deflation in residential real estate. And that's why ultimately the mean reversion there's not a snowball's chance in hell thing that the mean reversion is going to happen only by home prices. They will be cutting interest rates. They might not want to cut interest rates. They're not going to have a choice.
Got it. So the 30% potential mean decline, that would be off of the peak of February 22 is, I think, just to clarify that.
So from the peak, but I mean, so we're talking 25%. I mean, we're talking peak to trough.
Correct.
We barely come off the highs.
I agree. And I won't say the name, but even in today's Globe and Mail, there was another article around one of Canada's largest mix further gating and reducing distributions. And again, I won't say the name, just it's not appropriate, but basically things are tightening, right? Things are definitely tightening from what we're seeing as well. The U.S. was said to be requiring to refinance or issue close to $2 trillion worth of treasuries here in the next few years.
Yeah.
And we've had Fitch just downgrade them. What are your thoughts around how the U.S. is going to work their way through this debt issue? Part of me thinks that there has to be a very strong bias for the government and the Fed to drop rates because their interest costs are going through the roof. So am I right in that scenario? Like that's not something they're telegraphing right now, but what are they going to do with this debt? Because the math is the math. And we're seeing this dramatic hockey stick in the level of debt in the US and Canada for that matter. What would be your thoughts to share there?
Well, look, the Fed does not report to the Treasury. The Fed reports to Congress.
Yep.
The Federal Reserve Act is an act of Congress. So, I mean, the way that this would work through interest rates is that what we're going to be left with in the future is a complete lack of flexibility in terms of fiscal policy making, and we're going to be operating under some intense budgetary constraints. So insofar as that leads to what economists call as fiscal drag or fiscal restraint, it's going to act as a depressant on aggregate demand growth that will be disinflationary, and that's the process that gets the Fed to start cutting interest rates. The Fed's not going to cut interest rates to help out Uncle Sam.
Gotcha.
It's going to come through the impact on the economy. And that's exactly what we're talking about. Firstly, everybody's talking about Fitch. So the US is AA+. So what? Big deal. Canada's AA+. Okay, so what? Big deal. Do you really think that the world's reserve currency is going to default on its debt? It's just basically symbolic. Do you remember when the U.S. got downgraded by Moody's back in 2011? I mean, most people don't even remember that. But you see what that did. You see that ended up being a splash of cold water on the fiscal activists in Washington. It dramatically strengthened the Tea Party in the Republican Party, just like what Fitch has done is going to be disinflationary or deflationary because it's now going to embolden the Freedom Caucus in the Republican Party, and people aren't paying attention. You didn't ask me this part. This will not be in the paper in the next 12 months, but it will be in the next month. We could be facing a partial government shutdown by the end of September.
Yep.
So if you go back to that period, why that Moody's downgrade was so important back in the summer of 2011 was because it forced Barack Obama, who's very much an interventionist in the economy as Joe Biden is. But remember that there are checks and balances. Obama at that point didn't have full control. And Biden doesn't have full control, nor is he likely to after the presidential elections. And what happened was that in the summer of 2011, the U.S. was running a deficit to GDP ratio of 8%. And in the next 5 years, it went down to 3%. And that's huge fiscal drag that kept GDP growth low. And it allowed for a huge rally in bonds, and the Fed just basically was out of the picture. So and they kept rates at zero through the entire piece. So you got to think that if there's any significance from the Fitch situation, the downgrade, which is symbolic, but it was an important symbolic move. And as you said, the rollover of all this debt, 3/4 of the debt rolling over in the next 5 years, and interest rates that will be higher than they were upon origination means that debt service costs, it means that all the revenues coming into the government are going to be siphoned off to pay interest.
Yep.
That's going to leave less money for fun and games and goods and services. And that's going to be a dead weight drag on GDP growth. So while people said to me, well, bond yields went up because of this or that, because of Fitch, well, maybe in a static setting, a very knee-jerk myopic reaction, bond yields go up. I would say if you believe that bond yields went up because of Fitch, you want to be buying those bonds, because this will prove to be as disinflationary an event as Moody's was 12 years ago.
Interesting. So final question for you, relating this back to the markets, how to make money for investors, right? You've worked for a very large Wall Street firm, very successfully. Gluskin Sheff, you did a very good job in a leadership role there. If you were handed $10 million today, just pick a number. I don't want specific recs because it's not appropriate, but how would you be allocating that personally based upon what's in your head and what you think's coming?
Well, Thane, if I had $10 million, I'd buy your love. I think that well, here's where I would be advocating. This is where I'm putting my own money, and I think that you really do this through ETFs. But I think that energy, I'd say all forms of energy, and I would say certainly anything related, very bullish on natural gas and energy infrastructure. The greening of the world is not going away. So I would say that that energy ETFs, I'd have a chunk in there. I think that as we're grappling with geopolitical uncertainty, a US dollar, which has been looking wobbly, a great hedge against currency debasement, but also because I believe that real interest rates will be coming down. I want to own gold. And the question is, do you want to own the junior mining companies? Do you want to own gold bars? My last trade has been buying gold coins from the Royal Canadian Mint and storing it in the vault. So I'd say gold exposure is important. I like long bonds because we're past the peak of growth, inflation, and credit. And I think the central banks will be pushed to ease policy in the next 12 months. I want to own long bonds, and I don't mind having cash too. You're getting paid more than 5% to be in cash. Aerospace defense. Look, we talked a lot about Ukraine. We talked a lot about Taiwan. Defense budgets are going up around the world. That is a global theme. We just recently got the U.S. industrial production numbers. And if you're taking a look at output in the United States, that's in a bona fide bull market. It is definitely in aerospace defense. That's another area you want to pay attention to.
Bull market in defense is in essence.
So defense, energy, gold, bonds. I'd be looking at all those. I think the Japanese stock market's in a secular bull market. That to me, if there's a buy and hold, you can buy the Nikkei, you can buy the topics. I think that there's worse places to have your toes in, where Warren Buffett already is. And so I think that's Japan is in a secular bull market. And I'll tell you that I'm starting to like the Canadian equity market quite a bit. It's the all-in yield is so much stronger than it is in the United States. The all-in cash yield, valuations in Canada, 13-14 against 19-20 in the United States. If I have to be fully invested in the stock market, I certainly would be taking profits out of the U.S. and deploying them in Japan, and it even save some for Canada because the valuation metrics here are just so compelling.
What about emerging markets? What about
emerging? Well, as my mentor and friend Don Cox always said, emerging markets are markets that you can't emerge from in an emergency. And a lot of them are trading very inexpensively, admittedly, especially Hong Kong. But Thane, if you're worried about China like I am,
Yeah.
there's what looks like an attractive PE multiple over there is just a value trap. I think if I want to be in Asia right now, I mean, India is another secular story, but it's more expensive than Japan on a relative basis. But Japan is not an emerging market. It doesn't have liquidity problems. It's actually, Japan is benefiting. Maybe you can argue perversely, but it is benefiting from the problems that China's having right now. So I don't mind buying a market that's benefiting from China's problems. I just don't want to be buying markets that are right in the crossfire of China's problems. And that's the problems with emerging Asia, for example. Latin America, of course, that is a call on commodities. Frankly, if China goes into a recession, which is now looking likely, commodities will have question marks in front of them. But if I want to have a toehold in something that is commodity-like, I'd rather just own the TSX than go into the emerging Latin America market. So there you have it. You have energy, you have gold, you have aerospace defense, you have long bonds, have some cash on hand. I think I mentioned gold, Canada, Japan, and I'm out of breath.
Well, listen, thank you very much, David. We could talk for hours and hours. Always very interested in hearing your views. Keep up the great work on your research. And once again, it's rosenbergresearch.com. You can go to their website, check it out. I can personally and professionally vouch for all the good work that David and his team do. And thank you once again, David, for taking the time, and look forward to seeing the skunk at the picnic comments later. Talk soon.
All the best. Thanks again.
Thanks again. Thanks, David. Bye-bye for now. Listen, everybody, if you want to find out more about Stenner Wealth Partners of CG Wealth Management, our website is stennerwealthpartners.com. That's stennerwealthpartners.com. Have a take a look, and welcome any questions. Have a great day, everybody.
The comments and opinions expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. and should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF. The comments expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. and should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF.